Hi students, welcome to MI Academy. And today in this video we are going to study the grade 10 chapter 4 of the Business Studies, Introduction to Accounting. If you have not still subscribed to MI Academy, then click the subscribe button and turn on the notification bell icon to all, so that you can watch my upcoming videos without missing. So first let's see what are we going to discuss in this chapter. First we will be studying what is accounting, and then the objectives and need of accounting. Then we'll see what is known as business transactions, and then we will see about the terms assets, liabilities, equity, income, and expenses that arose through various business transactions. So what is accounting? Accounting can be explained as the process of providing information to the interested parties of a business for their decision making. Financial information is very important in decision-making in a business. Accounting provides financial information, so accounting is called as financial accounting. Then why do we need accounting for the business? What are the objectives of the accounting? As mentioned above, accounting is needed to provide useful information for the interested parties of a business for their decision-making. Further, the business activities also impact various other parties, who are known as stakeholders of a business. Accordingly, providing information is the main objective of accounting. Based on this main objective, there are various other objectives, and few of such objectives are given below. First one is, to know whether the business has earned an adequate profit. As you all know students, the main objective of the business is to earn profits. So the business to know whether they have incurred the expected profits, the businesses have to do accounting. To know whether the financial position of the business is sound, that means here through accounting, we can obtain the net worth of the business. And we can know whether the business is stable to continue. Then next is to fulfill legal requirements. For some organizations, to present the financial reports is a mandatory requirement by law. Then to minimize disadvantages arising through omission of transactions, and to organize financial activities. In order to fulfill above objectives, accounting provides various types of reports to the interested parties. These reports are generally termed as financial statements. These financial statements are based on business transactions. So let's see what are the business transactions. When a business carries out its activities, it requires to exchange resources with various parties. For example, when a business purchases goods on cash basis, cash and goods are exchanged between the business and the supplier. Accordingly, a transaction can be identified as an exchange of resources between a business and other parties. In a business, there can be various types of transactions. Among those transactions, the transactions which can be measured in terms of money are considered in accounting. Example: sales of goods for rupees 100,000. Monthly salary payment of rupees 50,000. Obtain a bank loan amounting to rupees 300,000. Payment of rupees 5,000 for electricity. In addition to the exchange of resources mentioned above, some events that had occurred in businesses are also considered in accounting. Examples: damage of trade stocks, rupees 10,000. A trade receivable that becomes a bad debt, rupees 3,000. These events are also considered as transactions in a broader sense in accounting. Most of the transactions that occur in a business are associated with purchases and sales of goods and providing services. Such transactions could be made either on cash or credit basis. If the value of the transaction is settled at the point of the transaction, it will be considered as a transaction on cash basis. On the other hand, if the settlement is made later, it will be considered as a transaction on credit basis. So from the transactions we can derive the terms assets, liabilities, equity, income, and expenses. So let's see what are these terms known as. The resources that are generated as a result of a past transaction are simply called assets. Example: purchase of a machine by a business. Purchase of a motor vehicle by a business. Assets generate future economic benefits to the business. Example: if a machine that had been purchased by a business is used to manufacture and sell goods, the cash that flows to the business in future from that machine. The profits that are generated by the future sale of purchased stocks. If any item does not generate future economic benefits, that item cannot be considered as an asset. Further, the item should be controlled by the business. This means, the business should be able to use that asset and to take decisions on the asset. For example, the above-mentioned machine and the stock should be able to be used by the business. A building on a rental basis cannot be considered as an asset as it is not controllable by the business. Therefore, the characteristics of an asset are: arose as a result of a past transaction, controlled by the business, inflow of future economic benefit to the business. Examples of assets: land and buildings, machinery, furniture, equipment, stocks, debtors, cash at bank, cash in hand. The assets of a business can be categorized into two types as current assets and non-current assets. The assets that are expected to be used, sold, or converted into cash in a short time period as 12 months are classified as current assets. Examples: stocks to be resold, loans and advances receivable that needs to be recovered within 12 months. All the assets that cannot be considered as current assets are considered as non-current assets. Examples: land and buildings, machinery, furniture, equipment, motor vehicles. Then let's see what are liabilities. Payables of a business that had arose as a result of past transactions could be simply considered as liabilities. Example: a loan obtained from a bank. The business is bound to repay these liabilities in future. Therefore, these are considered as current obligations. When these liabilities are settled, the resources which generate future economic benefits will flow out from the business. Example: in settling a bank loan, it requires to pay cash, therefore cash outflows from the business. Accordingly, following characteristics are observed in a liability. It is arose as a result of a past transaction. Outflowing of part of economic resources when settlement is made, having a current obligation. Examples of liabilities are bank loans, creditors. Liabilities also can be categorized into two types as current liabilities and non-current liabilities. The liabilities that should be settled in a short period of time as within 12 months are classified as current liabilities. These are also termed as short-term liabilities. Examples: trade creditors that arise when goods are purchased on credit for resale, expenses to be paid. All of the liabilities that cannot be considered as current liabilities are classified as non-current liabilities. They can be settled after 1 year. Example: bank loan. Next is equity. The value of assets that belongs to owners of the business is termed as equity. If the business has liabilities, a part of its assets has to be used to settle those liabilities. After the settlement of such liabilities, the assets that remains belongs to the owners of the business. Example: let us assume that a business has Rs 500,000 worth of assets and a bank loan amounting to Rs 200,000. Rs 200,000 out of Rs 500,000 of assets has to be used to settle the bank loan, and therefore, the remaining of assets worth of Rs 300,000 belongs to the owners. Next, income and expenses. Profit of a business is the difference between income and expenses. Profit belongs to the owners of the business. Therefore, profit must be added to the equity. Profit can be calculated separately and it can be added to the equity. Alternatively, income could be added to the equity and expenses could be deducted from the equity. In other words, equity is increased by income and decreased by expenses. As mentioned above, income belongs to the owners. Therefore, it should be added to the equity. As a result, equity gets increased. However, an increase of equity does not occur only from receipt of income. When owners bring additional capital to the business, it causes to increase the equity. This increase in equity is not considered as income. Therefore, income can be defined as an increase in equity except due to the increases from capital introductions by owners. Examples: sales, interest received, rent received, commission received. As income belongs to the owners, expenses should also be borne by the owners. Therefore, expenses should be deducted from the equity and it causes to reduce the equity. However, a decrease of equity does not occur only from expenses. When owners take goods or cash out of the business for their private use, which is termed as drawings, also the equity gets decreased. Therefore, expenses can be defined as a reduction in equity except due to drawings. Examples: salaries and wages, insurance expenses, cost of goods sold, interest expenses. The difference between income and expenses is identified as the profit or loss. If it is a profit, it belongs to owners, and if it is a loss, owners have to bear that as well. Therefore, profit or loss should be ultimately adjusted to the equity. Then, what remain are assets, liabilities, and equity. The relationship among these assets, liabilities, and equity could be shown in an equation. This equation is named as the accounting equation. You can learn about the accounting equation in the next chapter. We will be discussing it in our next video. Please subscribe to MI Academy and turn on the notification bell icon to all, so that you can watch my upcoming videos without missing. Also, please like my videos and add up your questions and doubts in the comments. I will try to reply them as soon as possible. Share the videos with your friends and help them to learn quickly and easily.